Okay, so if it's free on board shipping point, that pretty much means that the buyer paid the freight on that. If it's free on board shipping point, the buyer paid the freight. We include in the ending inventory of buyer, exclude from ending inventory of who? Seller. Good. And we have a sale, don't we? Okay. Now, if we're talking free on board destination, now, let me put it into slideshow. Free on board destination now means that what? Title passes to the buyer when they actually receive the goods. So if you took that same scenario, it was shipped on December, whatever I said, 15th, whatever, and it doesn't arrive until January of the next year, title doesn't pass until what? January of that next year, right? Okay, so under that situation, we would do what? We would include in seller's EI. Those items get included in the seller's ending inventory because even though they may be not in their warehouse anymore, the goods may be in Kansas City somewhere. They're going from New York to San Francisco, there's to San Jose, they're in Kansas City, but the seller still includes it in their ending inventory, don't they? Okay. And what? Exclude from buyers EI, and what else? No sale. Okay? All right. Things I think you know, but you can write those couple things down to help you kind of see some of the key points there. All right? All right, good. Now we come over, and if we have a right of return, because we're just assuming that the goods are going to be shipped, etc., and we're not considering the potential that there'll be some return. Now, if there is going to be a return, okay, and the goods are likely to be returned, GAAP requires now, and this is something that we talked about under the revenue recognition requirements, require that we go ahead and take a liability for the estimated amount of returns, right? And we're going to debit the sales returns for that, okay? And we don't recognize a sale until we have meet the following requirements. The price is substantially fixed, the buyer assumes the risk, the buyer is paid some form of consideration, the product is sold substantially complete, the amount of returns can be estimated. And if these things sound familiar, it's because we talked about these things in the revenue recognition chapter, right, that are necessary in order to recognize the revenue and thus say that the goods have actually been sold and move them from the buyer's ending inventory, from the seller's ending inventory, and include them in the buyer's. Okay. Now remember, we had the discussion that if there is going to be returns, we have to estimate what the amount of the return is going to be. Now, as a practical matter, what the company will do is they'll go ahead and they'll take their revenue at the time of sale, debit cost of goods sold. This company obviously is selling the goods for more than they paid for them. And then if there's actual returns during the year, the company just simply debits the sales return and credits the cash and puts the inventory back into inventory, credits the cost of goods sold. But by the end of the year, remember, they have to make that estimate of what would still potentially be returned. Okay, so they go ahead and they make that estimate, and they're saying that $70,000 is what they expect will still be returned, and of course that has a cost of $42,000. So as we said back in the whatever it was, revenue recognition 5 or chapter 7, I forget where we pointed this out. I think I pointed out in both chapters. We go ahead and we take that liability, right? Okay, but we also, and the reason I'm bringing this back up again, is we also would have to do what? We'll credit the cost of goods sold for what we estimate is going to be returned. They were 60% of the cost of goods sold. And we will, 60% of the sales price was their cost of goods sold. And we'll debit this account, which is basically adding to our inventory account, because we did what? We took those items out of inventory, didn't we? We took them out of inventory, but now we're saying, well, there's a potential to come back. So you wouldn't call it a contra, you'd call it an adjunct account. It's an adjunct account that does what? It adds to the inventory account for the estimated amount of returns. So we're actually going to put that number back into our inventory. It's going to add to our current assets, isn't it? That number right there, that 42,000. And then if there ultimately is a refund, of course, we would debit the refund liability, credit the cash, put those things back into what? Regular inventory, and take them out of the estimated inventory account as they come back. Okay? And a company just goes like that period to period. Now, sometimes it's a little confusing because students will say, well, wait a minute, what happens if they don't return all that stuff? The returns are different than what they say. Well, remember, we'll continue to make sales into the next year, won't we? And we'll take a what? We'll take a debit to sales returns, credit to our liability as debit to sales returns, I should say, credit to cash right here as there's actual returns, won't we? And then by the end of the year, we will do what? We will go ahead and adjust that liability account again based on what we still think are outstanding potential returns, right? Because it depends on how long we give them to return it. So you'll do this process every year. You'll always make that adjustment at the end of the year. So it's sort of like the allowance that we put amounts in during the year based on sales. But remember I said we always take an adjustment at the end of the year for what we think still won't be collectible. Same thing here. You always make that adjustment to the liability at year end for amounts you think won't be collectible. Okay? Question? All right, good. Consigned goods means what? Well, you write a book and you want Barnes and Noble to buy the book from you, right? And they say no, but they take pity on you and they say, look, we'll set the book up on the shelves in our store, and if somebody buys them, we'll give you 97% of the money, we'll keep 3%. How about that? But we're not buying the inventory for you. So if that's the case, what? Those goods are out on consignment, and at the end of the year, you would do what? You would you would include those items in your ending inventory. So the consignor, that would be you, should include the consigned goods in inventory because what? There has been not the passage of risk, that sort of thing. So I think we talked about that before. You would include those things in your ending inventory at year end, not in Barnes & Noble's ending inventory, right? There's no sale until it passes to a third party. They sell it to a customer of theirs. Okay, all right, good. So when you think about it, we know what items to include, specific items, right? Don't include items that you're holding on consignment. Include your own consigned goods out of someone else's warehouse. What happens if you're sitting there and you have estimated returns? You're going to sit there and still kind of pretend like those things are still in your inventory, right? Okay. If you are sitting there and you have goods in transit, free on board shipping point, you'll include them in your ending inventory, even if you haven't taken the physical possession of them yet. If it's free on board destination, you exclude them, right, until they actually arrive. Okay. So now that we know what items to include, let's see how we should value those, okay? And typically we're going to value them at cost, okay? And we say that inventory is accounted for at cost, which is defined as the price paid or consideration given to acquire the asset. Now, that includes what? That includes shipping costs, otherwise known as what? Freight in. So if you pay the freight in on the inventory, that's part of the cost of the inventory, isn't it? Okay, all shipping costs would be included. Freight in. Okay, so we would carry that at cost, and then we're going to see that we're going to have to consider the lower cost or market. Okay, now I ask you, is there any time that we can carry our inventory above cost? Can we carry our inventory above cost? Okay, and you're probably hesitating to answer that because you're thinking I'm going to tell you, if you say no, I'm going to tell you yes. If you say yes, I'm going to tell you no. Okay, well, pretend you said no and I'm going to tell you yes. Okay, which is yes, you can. Okay, and that is the case when we're dealing with precious metals, etc. What happens? Is there any question what you can sell gold for? No, at the end of the year or whatever, we know what the price of gold is. So if you so happen to be in the market, you're mining gold as your business, you can literally carry that gold at a higher net realizable value. Okay? Now, net realizable value means selling price less cost of disposal. In other words, you're not going to expect people to come out to the gold mines and buy the gold from you. You're going to have to get it to where you can sell it, etc., right? Okay, so we call that net realizable value. But even if that's above the cost for things like precious metals and farm products, let's just think about the precious metals, shall we? Okay, for those sort of things, you can carry them at a higher cost, at a higher net realizable value, I should say. I had a student one time who asked me, during the recession, the really bad recession, the person asked me, how come Tiffany's inventory is going up? And I'm like, because they're carrying precious metals and stuff, and gold was going through the ceiling at that time, because everybody's like, when we start panicking as human beings, we start coveting shiny objects. Okay, so what? The price of gold was going up. Okay, and so inventory for somebody that's holding precious metals could actually go up. Okay, good. Now,
So, do you consider, let's say you're putting the inventory in a storage place and you're paying about fee. Do you put that in cost?
Yes, the storing is part of the cost of the inventory. So let's separate that from the precious metals for a second. If I'm sitting there and my inventory is strawberries, and I got to keep the strawberries frozen to be able to sell them, that cost of the freezer, the depreciation on the freezer, any electricity I might allocate to that or storage is all part of the cost of the inventory. That's right. Okay. Now, in the case of the precious metals, I'm going to carry it at that higher net realizable value. So I'm not considering storage cost there. I'm considering, okay, what could I sell it for after I've incurred any cost to get it to where I can sell it. So if I'm actually storing the inventory, I'm not going to sit there and add that to the cost. That would just start to be some sort of operating expense at that point, because I've already acted as though I've sold it, or I'm acting as though I'm going to be able to sell it at that higher price. Okay. Exceptions now. Okay. Lower of cost or market exception. And I don't have to write an inventory down to a lower market if the ultimate sales price is not going to be affected. Okay, so what happens? I've got a warehouse full of steel, and the price of steel is dropping. But I know I'm going to take that steel and I'm going to build Teslas out of it. And where do they make Teslas out of steel? I don't know, whatever they make them out. And the price of Tesla is what? Going up, right? And there's more demand for them. I don't have to write that steel down to the lower market because my ultimate product is not being affected by that drop in the steel prices, whatever it is. Okay. Now, the other situation is what happens if I have a firm sales contract. Okay, I have already contracted with somebody to sell that inventory at a price that is higher than the current market. Well, I'm not suffering the loss because we have a contract that you're going to buy it from me for $500,000, even though the market price is now $400,000. I'm not going to suffer that loss. Who's going to suffer the loss? The buyer will suffer the loss. So the buyer will have to literally take a loss and a contingent liability, even if they haven't formally purchased that yet, because they have a contract to buy that. So that's on the buyer if there's a firm contract, and the seller to continue to carry that inventory at cost. Okay? So again, departures from cost, what are we doing here? Here we're saying you can keep that at a higher net realizable value. Here we're saying under the lower cost or market, you don't have to write it down to lower market if what? If the ultimate sales price of your product is not affected, or you're in a situation where you got a contract that you can sell it at a price above cost. You don't get to write it up to a higher market, you just don't have to write it down to a lower market. You just keep it at cost.
What's the other side of the write up to net realizable value? Is it a gain or a revenue or?
Obviously you're going to debit the inventory. You probably, FASB doesn't get all up in our face in terms of exactly how we call that out on the financial reports. Okay, so, I would think you could call it, because if it's a gain, it's kind of going to be seen as non-operating. Okay, so you'd probably write it up by debiting it. That's going to do what? That's going to increase your inventory account. When you sell it, it'll increase your cost of goods sold, right? So when it increases your cost of goods sold, that lowers your net income in later years, in the next year when you finally sell it, whatever. So yeah, I think you could probably call that some sort of revenue. I'd have to look that up. I'm not sure if it's going to be a revenue or a gain. I'm somewhat resident to call it a gain because that could very well be my business, right? Is I think where you're thinking.
Yeah.
So I'd have to think about that. I don't have that off the top of my head. That's a good question. Obviously, you're going to debit the inventory, is what I always thought about. Part of me want to say credit the cost of goods sold, but that's not right because that's going to be a poor matching, because it's going to reduce your cost of goods sold in a period that you'll take against your sales. Your gross profit will be higher, yet I haven't sold those items yet. They're still sitting in inventory, yet they have increased. So I'll have to look that up. Yeah, it's a good question. Probably a gain, if I had to guess. Okay, good. Let's go ahead and let's take a look at the lower cost or market, okay, versus, or we're going to look at both of them. I don't know if we're going to compete with them, but versus lower of cost and net realizable value. Okay, now what happens? We use the lower of cost or market for certain inventory methods, which is the LIFO or retail inventory methods. For everything else, we use the lower of cost and net realizable value. Now, I want to get into, though, this recognition of loss. What's your name again, sir? I'm sorry. Nick. I want to get into the recognition of loss because it kind of gets into what you were saying, but they instruct us on losses. I haven't seen instructions on gains in that situation. That's why I hesitate to answer your question, because usually they don't get that much up in my face and telling me where I have to classify those things, whether I take them as gains, losses, revenues, and that sort of thing. This is an unusual method where, for an unusual circumstance, where for the loss, FASB does get up in my face and tell me how to report it, okay? So they tell us that if there's a write down, it is usually reflected in the cost of goods sold. So if I write down, I credit the inventory, right? To write it down, I debit the cost of goods sold. And I'm doing this because the market value of the inventory has what? Fallen below the cost, and I have to write it down, okay? Now, they say unless the amount is material, in which case the loss should be specifically identified on the income statement. Now it's one of those significant line items that we're going to call out. Okay, we'd have it up in the operating section, but we'd call it out. Okay, now just as a point of interest for IFRS, IFRS does not get up in our face and start telling us where exactly we report it. And that's commonly what US GAAP does. They usually aren't all up in our face telling exactly what has to be called out as a line item. IFRS takes that stance back that they're not going to come specifically and tell me what I need to do with this. Now, when there's a reversal, US GAAP does not allow me to write it back up. So once I write my inventory down because the market has fallen below the cost, it stays down. I'm not able to write it back up. Whereas IFRS says, okay, you can write it back up, but not in excess of previously recognized losses. So you can write it back up to its original cost, but you can't continue to write it up to a higher market. I guess unless you're in one of those exceptions categories for the gold and that kind of stuff. But, okay. Okay, good. Now you come over and you take a look at the lower of cost or market. Lower of cost or market is what we use for our US GAAP only, okay? And it's not even all US GAAP. It's two specific methods, LIFO and retail method, which we'll look at both of these a little bit later. This is when you have to use this approach that we're about to talk about, lower of cost or market. Any other inventory methods, you should simply go ahead and use the lower of cost or net realizable value. Okay, so you come down and we start to talk about this term market value. And when we talk about market value in the lower of cost or market, it means replacement costs. But we have some limitations on to what extent we can use this net realizable value. And they tell us that we can use current replacement cost as our net realizable value unless the current replacement cost is above a ceiling or below a floor. If it's above the ceiling, you should use the ceiling. If it's below the floor, you should use the floor. Okay? Now, the key to knowing how to do this is to sit there and know how to calculate the ceiling and the floor. So, market value is going to be either what? Either the replacement cost, or if the replacement cost is over the ceiling, it'll be the ceiling. If it's below the floor, replacement cost will be the floor. We'll then compare that replacement cost to cost, and if the replacement cost is less than cost, we write it down. If it's more than cost, we leave the inventory at cost. Okay, hang on before you panic. Just take a look at how we do this. So we have the replacement cost. We take that replacement cost, we put it off to the side. And that could potentially be what we're going to carry our inventory at if what? If the replacement cost has fallen below the cost. Otherwise, we're going to do what? The market's fallen below the cost. Otherwise, we'll just leave it at the cost. But then we have to get the market ceiling. Now, market ceiling, they tell us, is the net selling price less cost to complete and dispose, which we call net realizable value. Okay, so net realizable value here is being defined as our selling price less cost to complete and dispose. Now, what are costs to complete and dispose? When I was first studying this, I mean, you mean like cost to throw it away? I mean, why would anybody buy something from me that I'm going to dispose of? That's not what it means. It means what? Cost to have it delivered. If we have to pay some sales commissions, that sort of thing, that will come off the sales price. That gives me what? The net realizable value. Okay? So that net realizable value becomes my market ceiling. Then I'm going to go ahead and calculate the market floor. Market floor is going to be the market ceiling that I just calculated less a normal profit margin. Okay? All right, now it's key, as you can tell, that we know how to calculate the ceiling and floor. Once we know the ceiling and floor, we will do what? Compare it to the replacement cost. If the replacement cost is over the ceiling, we use the ceiling. If it's below the floor, we use the floor. That'll be our market. We'll compare that to our cost. And if our cost is what? Is below the market, use the use the cost. If our market is below our cost, use the market, right? Lower of cost or market. All right, so you come over and you look at this example. Okay, I'm not going to go through every single one of these. We'll go through one or two of these and you're going to see that this is pretty easy. Okay, even though it sounds horribly complicated, it's really easy. So let's just go ahead and let's take a look at this example. And we have this item that has a cost of $20.50, okay? And they're telling us the company uses LIFO, so we know we have to use the lower of cost or market method that I just described, right? Okay. Now we come over and they tell me replacement cost is 19. And I'm saying, okay, that's my market, maybe, unless it is what? Over the ceiling or below the floor. I'm not sure that you're going to get this if you miss this example, okay? So now people get confused and they think that what they should do is walk out during the example, and that's like the worst thing you can do, because once you see the example, you go, oh, okay, that's really easy, okay? So they tell us that selling price on this is what? 25. Cost to complete and dispose is what? $1. So that's $24. I'm going to put a C there because that's my ceiling, right? Then I go ahead and I subtract that normal profit. That gives me what? 18. That becomes my, I'll put an F there, good, for the floor. So I look at the replacement cost. I'm down here now. I look at the replacement cost. It's 19. So it is what? It is below the ceiling. It's above the floor. So I can use that as my market, right? Because it's not over the ceiling. It's not over the floor. It's not below the floor. So then I take that 19, I compare that 19 to my cost of $20.50. Okay, I compare that to my cost of $20.50, which is lower. You don't know what's lower, $20.50 or 19? 19 is lower, so I would carry that at 19, right? Okay. Want to do another one? Okay. So I have what? I have cost of 26. I have potential replacement cost of 20, but I got to look at that replacement cost to make sure it's not over the ceiling, it's not below the floor, right? So they give me selling price minus cost to complete is $2. That gives me a ceiling of what, 28? I subtract a normal profit, that gives me a floor of 21. So now I've got this what? I've got this 28, I got this 21 sitting over here, and I'm going to look at the replacement cost, which is 20. So it's fallen below the floor, hasn't it? So my what? My market is 21. I compare that to the cost of 26, and I'm going to carry it at the what? At the 21? At the market? See what I told you about hanging in there with something that you think is complicated until you look at it and run a couple numbers. It's not that bad, right? So you take that replacement cost, you put it off to the side, you sit there, you calculate the ceiling, you calculate the floor. If the replacement cost is over the ceiling, use the ceiling. If it's below the floor, like we just did in that problem, use the floor. You then compare that to the cost, and if the cost is lowered, keep it at cost. If what we've determined now to be the market, doing this lower cost or market analysis, is lower, then you write it down to the lower market, right?
Where would you get your replacement cost?
You're probably, assuming you're doing something like this, you're in this business. So you're knowing, yeah, you're pretty much knowing what you're having to, what it cost to replace this. Okay. Now, we haven't done the cost flow assumptions yet. So what you're saying is your cost has been determined using LIFO, FIFO, weighted average, moving average, whatever you're using for your inventory method, that's where the cost is coming from. So if you were using LIFO, there's probably not a big difference between the market and, not LIFO, but FIFO. If you're using FIFO, there's probably not a big difference between what you're saying the market is and what you're actually carrying the inventory for. If you were using LIFO, there's probably going to be a big difference, right? But you should know, you could probably pretty much look at the last time you made a purchase of inventory, what did I pay for it? And that's pretty much what your replacement cost is, right? Yeah. Okay, I'm not going to do all of these, guys. Save some of these for fun, when you're hanging out and you don't have nothing to do. Okay, and notice here, Nick, they decided, and this doesn't answer the question you asked me, but notice here they decided to treat it as an individual line item for the write-down. Okay, I'm just unsure exactly where you would place that write-up if you have these precious metals and stuff. Okay, good. Now that's a little convoluted, right? So a while back, U.S. GAAP decided that they were going to do what IFRS does. So the IFRS approach is much simpler. But thanks a lot, U.S. GAAP. They still kept the complicated method for what? For LIFO and the retail inventory method. So thanks a lot. Okay. But for all other U.S. GAAP inventory methods, it's very simple. You simply do what? You simply take the net realizable value and you compare it to the cost to see which is lower. Now remember, net realizable value is selling price less cost to complete, right? So you simply take that net realizable value, compare it to the cost, which is lower. Net realizable value or the cost? Net realizable value is lower than the cost carried at net realizable value. Thank you, God. Except they had to keep that lower cost or market thing in there for us. For US GAAP, LIFO, and retail inventory method. Okay, good. Let's talk about difference between periodic and perpetual. Okay. Now, periodic may be a little bit challenging for you if when you studied it in intro. I don't know does Alex make you study this? What's her name? Alice or Alex? Alex make you study this? Periodic method? Okay, good. Because sometimes I know when I teach intro and I have non-accounting majors in there, I barely talk about periodic. Okay, I just talk about perpetual. Okay, because most companies these days will use perpetual, but for an intermediate class, yes, you have to know how to calculate the cost of goods sold using the periodic method. Periodic method assumes that we only keep track of our purchases. We don't update our inventory records at the end of the year. We don't update our inventory records as we have sales during the year. We wait until the end of the year, count to see what's left, and then we go ahead and make our adjustment for what we should be carrying on the inventory on the balance sheet. Now at the end, they both give you the same answer, don't they, for cost of goods sold and inventory? Okay? So, you need to know that you would take your beginning inventory plus purchases. How about freight in? How about freight in? Oh, okay, if you want to say including purchases, whatever, if I could give you a problem where I could say, here's the purchases versus the freight in, now what are you going to do? Okay, so it includes, I'm saying that because there's a question in the quiz in which they say, here's the purchases, here's the freight in. They also say, here's the returns and discounts. What do you do with those? What do you do with those? Returns, you're going to add? Once you said add and I acted like that, notice everybody very boldly said subtract after that. That's like one time I was out somewhere and I was hanging out with this guy. He's basically my boss. He's like a big guy that lifts weights. And for some reason, some guy started picking on him, a little guy. And so I made sure and stood there, right behind my buddy while that guy was picking. So I didn't figure that out. I stood right behind him. So anyway, so what happened? You sit there, and when somebody else is at risk, you feel real strong. Already you get strong. So what happened? What was funny about it is the guy was afraid of me. The guy, when I stood behind him, the guy go, "Oh, you got your mean guy here with you." This guy was like ripped. I don't know what that guy is. Anyway, so we have what? We have our beginning inventory, purchases, add freight in, subtract what? Subtract the discounts and returns, right? Okay, good. That gives us goods available for sale minus what? Minus the ending inventory then, and we wouldn't know the ending inventory until we did the physical count at year end, right? Gives me the cost of goods sold. Okay? So you've got to get good at this, guys. You've got to sort of know this like a Catholic priest. You ever hear the Catholic priest when they're talking about this? They say beginning inventory plus purchases plus freight in minus returns equals goods available for sale minus ending inventory equals cost of goods sold. You've got to be able to rattle this whole thing off. You can't just sit there and say, huh? How does this work? Because you can get real confusing on some of those questions, right, that I'm going to be giving you. Okay, now, that's the periodic method. Perpetual method is a method in which we will do what? We will keep a running total of our cost of goods sold after each sale, and we'll keep our inventory running balances. So every time we purchase inventory, we'll debit inventory, right? Credit accounts payable or whatever. Now, most companies these days, as I've mentioned, use the perpetual inventory system because of two major inventions. One, computer. Two, barcode scanners, right? So that now, when you go to the store and they're checking you out, you know, and they bleep, and you think, oh, they're doing that so they can give me my receipt, but they're also doing that because it's updating their inventory records, right, as you're buying stuff. So most companies do that, but we need to be aware of the periodic method, okay, in this class. So if you look at this next example, we're going to compare the two methods, okay, and this is kind of flipped. Now that I think about it, I could have controlled which one I put first, and I should have put the purchases first, okay? So we purchase inventory. If we're using, let's do perpetual first because that's easy for us. If you're using perpetual, you would debit inventory, you credit cash, accounts payable, whatever, right, when you acquire the inventory. And then when you sell it, of course, you're going to sell it for more than its cost, so you would debit your cash, credit your sales price, debit the cost of goods sold, credit the inventory at its cost, right? Okay, very simple, perpetual method. Under the periodic method, we wouldn't debit inventory when we buy it. We debit purchases and credit cash as we purchase the inventory. Then when we sell it, and what I don't like about this example is they sit there and they show me the entry for the sale. Okay, great. But they don't show me the year-end catch-up entries. We're going to have some year-end catch-up entries now as we go through, count our inventory, etc., see what's left, right? Okay. Now, just peeking at what we understand from what they told us from the perpetual method, just peeking at that, if I look at my inventory account, I initially debited it for what, 300? And I credit it for 100, and I have a cost of goods sold of what? Of $100 here. Okay, so I know the answer to the question on the journal entry, right? In the real world, I'd have to do what under periodic? I'd have to count the inventory and see that I have 200,000 left, wouldn't I? That's when I would know. Okay, so I would go ahead and under the periodic method, the year-end EOY entry to catch things up would be to debit inventory for what? For how much is left? 200,000. Again, I would have counted to see that 200,000 left theoretically under the periodic method, right? Because I wouldn't know until I counted. I would debit, I would go through my Catholic priest formula. I'd have my what? I'd have beginning, which I'm going to assume beginning is 0. I'd have purchases, which were what? 300,000. That gives me goods available for sale of 300,000. I'd count my ending inventory minus my ending inventory, which I determined to be what? 200,000, and I would know then that the cost of goods sold was 100,000. So I would debit cost of goods sold, right? My end of year journal entry to catch up. And now I don't need the purchases account anymore. I can close that. I can close purchases now, can't I? I don't report that on my financial statements. I'm just going to report cost of goods sold in the inventory. So I would go ahead and credit purchases for 300,000. Is that what I would do at that point? Okay. All right. So that's the way the periodic method works, and that you're going to have to wait till you're in to count the inventory to see what the amount of ending inventory is to then calculate your cost of goods sold, right? Okay. And perpetual you've known for a while now. All right, guys. Let's stop. We will pick up on Wednesday, starting to talk about these inventory methods. You want me to save this? And please sign in, and whoever had the attendance sheet last, please return that back to me, okay? Thank you. Did everybody sign in?